of intervention from the Bank of Japan in the early part of this week, and more importantly, on back of the dollar giving up some of its gains. Well, like we said, the man of the week is the Fed chief. Key highlights of the much anticipated Powell-led FOMC decision. Benchmark interest rates were left unchanged at 5.25 to 5.50, which continues to hold at a 22-year high. The Fed has said that they will not cut rates until inflation is sustainably around that 2% target of theirs. Lack of further progress on inflation, economic outlook looks uncertain. That's what the Fed has continued to maintain. The Federal Reserve's policy statement on Wednesday was more dovish, and I think that's what equity markets took a little heart from in overnight trade at the margin than markets anticipated, with no hint of a potential rate hike. So remember, from the end of last year, we've gone from rate cuts to rate hikes to stagflation to inflation, and now going back to a potential rate cut as early as July. Well, Fed has also said that they would slow down the pace of balance sheet runoff starting as early as June, again more or less on expected lines. Yields on the 10-year has dropped 9.2 pips, which is the biggest drop seen on the 10-year since Feb this year. Gold has rallied about 1% on the Fed's move. Crude has actually declined quite sharply, maybe to do with dollar weakness, and also, of course, the fact that U.S. inventories have continued to see a rise. Along with that, the Fed chair also ruled out any sort of concerns on stagflation. Remember, these were questions coming in from the media that was also present, taking the best of the opportunity to understand what the Fed's dot plot looks like. But for now, it looks like no rate cut, no rate hikes, and also no rate cuts until July. And in terms of important data that came out, labor cost has actually risen in the U.S., and that could be viewed as slightly negative, at least in terms of inflation. That was the Fed, and that was crude and gold, and Asia clearly not doing too much in early morning trade on back of that. But of course, markets weighing every ounce of what the Fed chief said with caution. Citi, of course, put out a note saying that largely in line with what the street was expecting. The fact that it was less dovish than what the margin of the market was expecting is what could be responsible for a little bit of calm across global equity markets. A couple of other things. It's going to be earnings heavy for the U.S. The likes of Apple will be reporting later on in the day. You had Cognizant that reported post-market hours. The stock was up 4%. Usually Cognizant is important in context of what happens in terms of IT spends. The numbers were largely below were not very strong, but they were better than what Cognizant had guided for, and that's what the company took heart from. The stock was up 4%. Top line was on the higher band of the guidance. Headcount has continued to reduce. Client wins also remain slow. But then again, the stock did react positively, and that's what we're looking at. That could have an impact on IT stocks back home, but there's so much more than just IT stocks back home. You've got earnings, you've got auto sales, you've got Kotak, you've got Godrej, and the list is extensive. But the benchmark was very interesting on what happened on Tuesday.
Yeah, I was just going to say add the expiries to that list, because it was quite a crazy expiry. The last 1 hour of trade was, some traders would call it insane. I'm going to tell you what's happened. So, it was, of course, the confluence of the Fin Nifty and the Bank Nifty expiry on Tuesday. And through the course of the day, all the way until 2 o'clock, it was absolutely flat. All the indices were consolidating, and suddenly at around 2 o'clock, you see a sharp surge upwards, taking out all the call writers, and then following that, in the next 1 hour or so of trade, you see a sharp decline, and from there onward, the Bank Nifty has fallen as much as about 700, 800 points from the day's high. Remember, the Bank Nifty was also trying to make a beeline for 50,000. But that didn't come through. So there is no doubt about the fact that these are choppy markets. There's a lot of indecision. There's a lot of uncertainty. And, for those who are very, very certain about their positions, in that case, profitability is not necessarily a guarantee for them either. What are we looking at the moment? Last Tuesday, we did see the Nifty make a new high, but it also came off from that day high and from a life high. Well, at the moment, we are looking at the Nifty sitting at around 22,600. We have a little bit of a base being built around 22,450, 22,500. That's where we're seeing an immediate weak support of sorts. And should we see the Nifty break that in today's day of trade, well, again, it's going to turn out to be yet another very, very choppy expiry. And of course, today is the Nifty weekly options expiry. On the higher end, we're keeping an eye on short. 23,000 does have a lot of accumulation, but I reckon that, that's not the mark that we're going to watch out for today. We're going to keep an eye on 22,800 because that's where we have a significant amount of writing coming through. And remember that Nifty's new life high is just about 17 points, 15 points short of the 22,800. So 22,800 will be a significant resistance zone at the moment in today's day of trade. But should we actually break that, you never know. You may actually see a lot of short covering as well. In general, what has also aided the markets was that fundamentally we've seen inflows from FIIs and DIIs, and both have bought stock worth well over 1,000 crores on a net basis. Not a very large number, but the fact that institutions are buying both foreign as well as DII, that's a positive. In terms of some of your other key metrics, if I look at the Nifty put-call ratio, that's at a fairly neutral range of around 1.11. And the FII long number in index futures stands at around 52%, which is also very, very neutral. So there certainly is going to be continued indecision. And remember that we're heading into the next phase of elections. So it's not just going to be about earnings, but also elections, and it's going to lead to an increased choppiness. And the premiums, the option premiums speak for themselves. But again, we're going to keep an eye on the 400-point range today because it's also the Nifty weekly options expiry. And those are the levels that we are working with.
Agam, while it's going to be volatile, let's not forget that in every election year, the month of May has actually done spectacular returns for the Nifty. So you go back to the previous election years and you've seen how well the Nifty has actually closed out for the bulls on the street. And interestingly, it's Bank Nifty that actually even outperformed the Nifty further. And we saw that trend. In the month of April, Bank Nifty outperformed the index. In fact, 3 months on a roll, Bank Nifty's actually outperformed the benchmark itself. Even in the month of April, not just comparing to the Nifty, but Bank Nifty has been an outperformer as compared to most Asian markets and most of Wall Street as well. On the 30th of April, which is on Tuesday, after it did a big U-turn, Bank Nifty did actually make a new record high of 49,974. However, it was profit booking, like Agam said, in the latter part of the session that led to the decline of over 500 points from its high, causing it to actually end slightly lower. It was volatile and we can't take that away, but the fact remains that records were made and the markets are looking comfortable. This could be par for the course is what I would have imagined. But nevertheless, we've got with us the big talking point this morning is the Fed and the outcome of that much anticipated Fed decision. We have with us a very special guest joining in to talk to us about what he actually made of that Fed move. Robert Sorkin, Senior Global Economist of Citi Research, now joins in. Good morning, Robert. Thanks a ton for joining us this morning. Robert, how are you looking at this? The last I checked was no one was talking about rate hikes. We were just disappointed that rate cuts were delayed. This morning, of course, the street seems pleased that rate hikes were not mentioned and a rate cut could be potentially down the road as early as July. How did you read into the Fed statement? Because I feel like the markets are choosing to read commentary the way they choose convenient at this stage, as opposed to actually taking it as it is or as it should be.
Yeah, absolutely. And thank you so much for having me. It was a very interesting meeting. As you noted, I think there were more market participants or greater fear among market participants that Chair Powell may put hiking again on the table, given the very strong inflation prints we saw in the first quarter, given that the employment cost index, which is the best measure of wage growth, came in far above expectations as well. But that provided some relief to markets that Powell really did not lean into the possibility of hiking further. He really feels that the rates are restrictive and that they can just hang out at current levels for longer if inflation does not make as much progress as they would like. So that was kind of a positive, that it would really take a lot from here to get the Fed to think about hiking again. Now, in terms of cuts, I think people are taking comfort in the fact that Powell did not remove completely the idea that cuts could be coming this year. He admits that progress has stalled and that they would need to see further progress to really gain confidence that inflation is moving back to target. So I think the big news is making sure that hiking is off the table, it seems, and easing is not off the table, but just perhaps more delayed than the Fed was thinking just a few months ago.
Right. Robert, we've had, of course, very clear commentary that the Fed has indicated that they need inflation to be around 2% before they even think of moving on a rate cut cycle. How do you feel that's playing out? Because we did have some data which show that labor costs were on the way up. And in the backdrop of wanting inflation at 2%, how do you view that? Do you even feel like July is even a realistic timeline? Because otherwise what's going to happen is you're going to raise your hopes on a July rate cut. None of that's going to come through, as we've seen in the last few months. And then that can gets pushed down the road once again.
Yeah, and this is really challenging. You know, our base case does remain a July cut. And Chair Powell did open the door to thinking about easing rates if they become more concerned about weakening in the labor market, weakening in activity. And so if the economy does slow down more distinctly as we go into the middle of this year, and you do see some cooling in inflationary pressures, that may be enough for the Fed to start cutting in July. But that's a very tall order. You would have to see some combination of a deterioration in activity and inflation numbers coming in good enough that they feel comfortable cutting at that stage. Now, in terms of the inflation data, assuming that the economy does remain resilient as it has at the start of this year, absolutely, you know, as noted, we have seen both on the wage growth side and particularly within services sectors, we're still seeing fairly sticky inflation pressures, and that's really tied to that still elevated wage growth. And, you know, I think that's really what you heard from Powell is a lot of uncertainty about where those numbers are heading. There are some reasons to think that the Q1 data could be abnormally strong for non-fundamental reasons. Maybe there's statistical seasonal adjustment issues within the data, but that remains to be seen. And we really need to see how the inflation and labor market figures evolve in Q2 to really get a better sense of how much signal was there from that Q1 data. And I think that's exactly what you heard from the Fed today, is that they're not really sure. They still think that they'll make enough progress on inflation this year, but Q2 is going to be really determinative in deciding, you know, how their posture is going to look in the second half of 2024.
Right, Robert, you know, what we really are struggling to understand is that just a few weeks to a few months ago, the narrative, the conversations have shifted from, well, rate cuts, which have at the moment seems to have you know, not appearing anymore, to rate hikes at the moment. Why is there so much confusion, if I can say that, and why is it that and how does the debt to GDP, you know, picture come into or considerations as far as the Fed's concerned?
Yeah, these are great questions. I think if you go back to the beginning of the year, the market was looking at the second half of 2023. They were seeing resilient economic activity and inflation on kind of a 6-month basis, really running near the Fed's target. And you've had the market kind of pricing in a very rapid easing cycle from the Fed this year, given that progress. And I think maybe the market's got a little ahead of themselves. Especially because, as we've seen over the last few months, the Fed really wants to be sure that inflation is moving back to its target in a sustainable way. And you know, so they needed a lot more data than what they got in the second half of last year. And the data, as we've talked about in Q1, have really gone against that thesis, or have really brought into question that inflation is moving back steadily towards the Fed's target. And that's why you've seen this narrative shift from nearly 6 cuts priced in earlier this year to something closer to 1, and even some people starting to talk about maybe the Fed would consider hiking from here. Again, Chair Powell pushed back against the idea. I think the bar for that is very high, but it's because the data in Q1 have really worked in a different direction that you've seen that narrative shift. Now, in terms of the government's debt, there's no question that the government is still running large deficits. Debt levels are high in the U.S., and you're seeing interest cost on that debt rise, given the large deficits and the high interest rates we have now. I do not think that's what's playing into the Fed's decisions. The Fed is focused on getting inflation back to target and maintaining full employment, and is not thinking about the cost that comes to the federal debt from these interest rates. Now, for the federal government, I think that does highlight a different issue, which is that they are running very large interest costs, and there are questions about how long that type of situation can run before markets start demanding even higher premiums on government debt. So I think the government issue is separate from the Fed, but is also a concerning dynamic in this environment.
Robert, what does all that mean for emerging markets like India? We've, of course, seen FPI sell out of our markets in the month of April. China, on the other hand, has seen inflows. The Japanese yen has declined quite sharply, which has also led to some money going into China. If I had to ask you for FY25, where does India sit on the pecking order?
Yeah, and this is a great question, because for emerging markets, I would highlight a few points. One, fundamentals tend to be quite good there. We're looking for very strong growth out of India again this year. A little bit of slowdown relative to last year, but last year was an exceptionally robust pace. And more broadly, other emerging markets hold up quite well in our forecast. We recently upgraded China several weeks ago to 5% growth on the year. Data on balance have been fairly good there for much of 2024. And you can look across a lot of other EMs where we've seen broadly positive stories. So I think the EM fundamentals are in a good place, and you're seeing fairly good growth stories. India's, as I said, is a great example, but in many other EMs. Now, where our discussion today comes into play is I do think that Fed policy has a large impact on global interest rates and exchange rates and large implications for emerging markets. And what you're seeing is, I think, if the Fed is going to stay higher for longer, that I think is at the margin going to influence the decisions of other central banks around the world. And you're starting to see kind of a rethink among many central banks about how fast they can ease policy in this environment, both because of resilient activity and inflation, but also because the Fed is such a guiding light for global monetary policy. And the longer the Fed stays higher, the more difficult it is for other central banks to diverge from that. So I think emerging market stories are very good. India is very positive, but the Fed's policy is going to be very important for seeing how FX and rates evolve in EMs.
You're right. If the Fed doesn't cut rates, it's going to be bad for markets like us. But one last question before I have to let you go. How do you feel about the Indian bond markets at this stage? Risk reward in favor of Indian bonds over equity. We also get included in the JPM index, and that's been the biggest talking point for Indian investors. How does that play out? Would you pick Indian debt or Indian equity at this stage?
I think, as I said, I think India assets in general are a very positive story. I think both in terms of the debt market fundamentals and also the equity market fundamentals are very healthy. And as I mentioned, we're looking for very strong growth in India this year, but beyond that, have a very positive outlook on India in general, especially given relatively favorable demographics compared to some other large EMs. A lot of positive investment stories coming from the government as India, as well as other emerging markets, are, I think, benefiting from shifts away from China towards investment in production and other EMs. So I think that's an important tailwind for India, among many other positive growth fundamentals. So I would think that assets more broadly in India look attractive, both on the fixed income and the equity side.
Right. Thank you, Robert. Great talking to you this evening to get some perspective on the Fed, on emerging markets, and of course, Indian equities and asset prices. We'll hopefully catch you soon. In the meantime, like we said, implied Nifty is indicating to a flat to slightly higher start. Just before we had that midweek holiday, Tuesday saw the markets to a very sharp U-turn in the second half of trade. So it was volatile, finally seeing the Nifty go home with a small cut, and so did Bank Nifty. The focus this morning, once again, while will remain on the broader markets and the benchmark itself, it's going to be earnings that the traders and investors will be focusing on. Let's quickly highlight for you what some of these counters are looking like in terms of reporting this morning. I'll start with a couple of cement majors, AC. So Adani Group companies reported earnings, and they were pretty impressive to say the least. But we'll start with ACC Ambuja. Numbers reported from the cement majors was largely better than what the street was expecting. Good capacity expansion led to an improved number on top line. Revenue for ACC was up 13%, and profitability improved substantially, up 300%. Overall realizations, though, were on the softer side. Margins, on the other hand, for Ambuja, if we can move on to Ambuja very quickly, were not looking too bad either. The numbers were good. The margins also saw a big surge coming in on Ambuja. So that's clearly what we had in terms of earnings from ACC Ambuja this morning. Along with that, Adani Power as well reported numbers. Largely speaking, those numbers were more or less in line with street expectations. You're seeing a 47% decline on profitability because of deferred tax, which had a positive impact on the company in the same quarter last year, was of course a negative one in this quarter. So core business continues to do really well. The weakness on profitability is only because of an item which is outside the core business. Revenues improved substantially for Adani Power, up over 31% to come in at 13,364 crores from 10,242 crores. Margins also expanded substantially to come in at 36.29% versus 18.62%. So all in all, good quarter for Adani Power, good quarter for ACC Ambuja. Both those counters are going to be what you want to watch out for this morning. While realization for Ambuja Cement was slightly softer, the fact remains that the numbers apart from realizations look good. Top line, of course, seeing an improvement on back of capacity addition.
All right. Well, moving on to a handful of other good numbers coming in. And of course, right at the top, we have Havells. It's something which has been in focus. Remember also that last quarter, we had a lot of volatility with respect to one of its peers. And that's where Havells did get a lot of impetus. But, as far as the numbers are concerned, it does seem like it's a beat. It's higher than expectations. So we're looking at revenues, which is rising around 12%. But what's really heartening, I reckon, is the improvement in operations, which is why we're looking at a net profit number higher by around 25% on a year-on-year basis. The switch gears has delivered a decent growth despite higher base. We've seen cables and wires maintain growth momentum as well as far as Havells is concerned. It does seem like an expensive stock at the moment, but, well, we don't have too many with the kind of growth profile, specifically when it comes to the bottom line. And Havells, of course, is one of those steadier options available in the markets at the moment. Let's not forget that growth in electrical consumer durables has also largely driven by summer-led demand, which has, of course, been the case in terms of peers as well, but that's panning out well. The other stock that we want to have in focus and talk about is IndiaMart Intermesh. Again, this is another company which has continued to do well. Steady numbers coming in, 17% growth in terms of revenue. We're looking at a 78% growth in its bottom line at 100 crores against an expectation of 80 crores. So it's a beat there as well, an operational one. And I reckon that a lot of investors who are already invested in this will be happy with the kind of performance that IndiaMart Intermesh has come up with. And we also talk about Gravita India. This is a relatively lesser known stock, but there are a lot of high net worth individuals who are tracking this one. Of course, this is one is into lead products. It's also had a fairly good quarter coming in. We're looking at 15% growth in revenue. Its EBITDA is up as much as nearly 14% as well. And its profit has, well, up just around 8.5%. But that's because of certain operational difficulties through the course of the quarter on a year-on-year basis. We've seen a marginal decline in its, as far as margins go. Overall, board has approved an interim dividend, but the volumes growth, that looks like it's coming in around 14%. So I reckon that is the realizations which have weighed on the revenue. But all in all, it certainly does look like a reasonably good quarter. And the other big takeaway, of course, here is that Gravita is looking to diversify into lithium-ion, steel, and paper recycling as well. It's something that could eventually add more avenues for revenue for the company going ahead.
And I'm just going to continue the list of reporting because that's an extensive one. Adani Total as well reported numbers, good set of earnings. They've also announced a dividend. Net profit was up 72%, and that's what the markets will take heart from. All in all, solid quarter in Adani Total in terms of reporting revenue of 71.6%. Net profit was up to about 168 crores in the fourth quarter against 98 crores in March 2023. Revenues rose 4.7 crores to 1,167 crores in the last quarter against 1,114 crores. They've recommended a dividend of 0.25 paisa per equity share, 1 rupees. So that's a pretty good set of earnings coming in from the Adani stable. Along with that, Adani Wilmar as well had a good quarter in terms of what we've seen. The food and FMCG volumes have hit the 1 million ton mark, and that's what the street is going to be excited about. EBITDAs have sprung up very, very sharply, up about 103%, to come in at 363 crores versus 178 crores. Profitability also saw a huge jump of 68% with a reporting number of 157 crores. March sales in edible oil was also very, very strong, which led to a little bit of a bump up in terms of what we've seen on numbers. So Adani Wilmar, Adani Total, Adani Power, ACC Ambuja are some of the, and Adani Energy are the counters that reported earnings. Just a quick disclaimer, the channel you're watching is a group company of the Adani Group.
Right. And we'll move on. We have auto sales which are starting to come in. And right at the top, of course, we have Maruti Suzuki. Now, on a year-on-year basis, if you keep an eye on that, we've not seen a staggering growth here. But and it's actually, in fact, the numbers slightly below the street expectations as well for the month gone by. And as far as Tata Motors is concerned, that's also something that you can keep an eye on. Again, only a tad bit lower than street expectations when it comes to the monthly numbers coming in. We move on to the two-wheeler segment where we have TVS Motor Company. Again, good growth coming in as compared to last year. But, and of course, this one is higher than expectations as well. Eicher Motors, on the other hand, while it's also looking at a good growth coming in, that's also slightly higher than what the street was working. In fact, all the two-wheelers so far are looking at good numbers coming in. And, it's the same for Hero MotoCorp as well. Coming down to commercial vehicles, again, well, a little bit of an outperformance for Tata Motors commercial vehicles, not as much for Volvo Eicher, and Escorts largely in line with expectations. Moving on to RVNL, we do have yet another project being won. This one is worth around 391 crores. And talk about Indus Towers' earnings as well, looking at 6.5% growth in revenue. Margins have, well, expanded by as much as 600 basis points nearly. That's coming in at around 57%, and profits are looking up at around 32%. So good earnings, operationally beat as far as Indus Tower goes.
Yeah, you can add Sona BLW to that as well. Good earnings from them and good earnings from Vedanta Fashion. We will, of course, analyze that with our guests shortly. But a quick mention before we go into a break is going to be Kotak. The joint MD KVS Manian has stepped down. Now that it could potentially be another slew of bad news coming into the counter, so watch out for how Kotak reacts in trade this morning. There is conversations and we have some information that he could be moving as to federal banks. So those are two counters you want to watch for in trade. BSE as well, they've revised their charges on derivatives, all that and more on the other side, but that's a whole bunch of counters we will be tracking in trade. We'll take a break, we'll come back and set you up this morning as we gear up for another volatile session on D-Street.
Welcome. This is India Market Open. Well, we are taking stock of the futures and options space. It was an extremely choppy day of trade when it comes to Tuesday. The last 1.5 hour on Tuesday was an extremely difficult one as well, with a significant sharp moves both on the upside and the downside. Today is the Nifty weekly options expiry. Can we expect more difficulty when it comes to trading? Well, it's not an easy time to be an options seller in such markets. But I'm going to start with the basics. Let's talk about the futures. And we didn't see too much change in the underlying. At the end of the day, the Nifty did come off by less than 0.2%. And we saw very little change in the open interest as far as the May futures go. The Bank Nifty futures, again, the picture wasn't very different, though we did see an increase in open interest there. But the index looks flat, but don't go by the absolute number, because the Bank Nifty was a little bit of a chaotic, we did see a little bit of a chaotic move in the last 1.5 hour of trade. Of course, this was punctuated by the fact that both the Fin Nifty and the Bank Nifty expiries were on the same day, and that could have potentially led to a lot of rockiness in the last couple of hours. But moving on to the options market today, we have the weekly Nifty weekly options expiry. This is your overall open interest distribution picture for today's expiry. While 23,000 call does have a significant amount open interest, I reckon that it's not going to be as relevant as perhaps something like a 22,800 call, where you do have a reasonable amount of calls being written there. On the lower end, once again, 22,500 puts are the one with the max OI at the moment, but I reckon that given the kind of volatility, given the kind of choppiness that we've seen off late, I reckon you could potentially keep an eye on something like a 22,300, 22,400 as well, in order to give you a wider range. But moving on, in terms of stocks, keeping an eye on something like an Exide and HDFC AMC, which did in fact see longs, shorts for HCL Technologies, Dr. Reddy's and Birlasoft. And on the other hand, in terms of stocks which saw unwinding, we saw about a short covering for Jubilant Foodworks, Shriram Finance, SBI Cards and Escorts. But moving in, what can we expect from the markets? And based on the expectations, how can we place bets in the options market? Well, let's get an expert here. We have Rahul Ghosh of Hedge.in joining us in the show today. Rahul, good morning. Thank you so much for joining in. Let's start off with your overall view on the benchmarks, the Nifty and the Bank Nifty. What's the way forward here?
Good morning, and thank you for having me. So if you notice, for the last couple of weeks, our view has been that May is going to be a 5-week expiry, and 5-week expiries are generally volatile in nature. And true to that, that is what we are currently seeing playing out in the markets. Two levels I want you all to look at. Number one, I expect May series to see sub 22,500 levels. That is point number one. Point number two, the current range is between 22,550 and 22,800. If you have a close below 22,550 today, which is just about 50 points away on the downside, you will see 2-3 days of consolidation or 2-3 days of down move. That is point number one. Point number two, if you're looking to go long, I would suggest wait until 22,800 gets crossed, because the rejection that happened on Tuesday was not a small rejection. It was almost 250 points on the downside from the peak. So it's time to be a little cautious when that kind of rejection takes place from the high the third time round. Coming towards the Bank Nifty index, it's a better index to play for the long side. However, the concentration of short straddles around 49,000 and 49,500 makes us believe that there might not be any sharp down move or any sharp up move, at least for the next week to come.
All right. But based on that, Rahul, how are you placing your option structures? What kind of option structures are you playing as far as the Bank Nifty goes?
So we're looking at a bullish to neutral structure in Bank Nifty, taking into consideration the open interest data that I just mentioned about. So we're planning a call butterfly. Generally, the structure of a call butterfly works where we buy a call, we sell 2 calls, and then we buy a call. It's basically a forward-looking ratio spread with a protection on the upside. So the first leg over here would be 49,700. What we're doing is we're looking at the 15th May expiry, which is about 2 weeks away. So we buy the 49,700 call. We sell 2 lots of the 50,200 call. Once again, 15th May expiry. And we buy again the 50,500 call, again of 15th May expiry. Now, when will this trade make money? This trade will make money if Bank Nifty moves up and stays anywhere above 49,700. Point number two, if Bank Nifty stays sideways for a couple of days, this trade will again make very, very small, but would still make money. And if Bank Nifty moves towards the downside, which is contrary to our view, the loss in the trade would be approximately 100 points or 1,500 rupees based on the lot size of Bank Nifty. One more point over here. In case you see Bank Nifty below 49,000 and you're above 10th of May, one can even roll down the sold calls to make the risk in few hundred rupees, that is 5, 6, 700 rupees, to make the trade even safer. But it's important to note that this has to be done only after the 10th of May and only if Bank Nifty is trading below the 49,000 level.
And of course, you stand to make the most if the Bank Nifty is close to around the 50,200 mark, in and around, and of course before 15th of May. But Rahul, let's move on and talk about stocks as well. The first one on your list, I reckon, is SBI. Can you take us through that one?
The last 2 weeks, we had, if you remember, Tata Motors and BHEL, and both we played on the long side. Thankfully, both played out very, very well. Both gave good return on capitals from a bullish strategy. Today, we're looking at M&M rather than SBI, and we're giving a slightly conditional buy in M&M. The current market price is around 2070. Beg your pardon. The current market price is around 2050. Above 2175, we can initiate a long, or if you see some correction towards 2100. So both cases, I'm keeping it open. I repeat, above 2175, or if there is a retracement to the 2100 level, we can plan a bull call here as well. M&M is actually at its all-time high. And in general, if you look at the auto sector, it's one of the better sectors which should continue to perform for this year. So we can look at the 2200 call and the 2240 calls sold. That is a simple bull call where we buy the 2200 call and we sell the 2240 call, keeping the caveat of these two levels where the trade has to be initiated in.
Okay, well, a straightforward bull call spread being played on Mahindra & Mahindra. Rahul, on that note, taking a moment to thank you for joining us and taking us through your views on the markets, as well as helping us with a handful of option structures that we can, in fact, deploy on the ideas that you've given us. With that, it's back to you, Samina.
Thank you for that, Agam. That, of course, is the F&O picture. It looks like it's going to be an interesting, volatile day of trade. Between all that, there's going to be important, and this one actually comes in from a standpoint of an old conglomerate as we know it. The 127-year-old Godrej company has been split. In fact, the Godrej family has reached an agreement to split the conglomerate into two branches. As per the settlement, Adi and Nader Godrej will control the listed companies, while cousins Jamshed gets the control of the unlisted entities and the land bank. Well, the agreement which was submitted to the exchanges will address the issue of royalty, brand usage and land bank development. Also, what you want to keep in mind is that the lawyers who did advise both parties have said that this was done amicably well. It was done over a period of 4 years. And of course, with the good taste that this was done in, it could be the blueprint for future, of course, realignments of families that may come our way. Along with that, Cyril Shroff has also said that the negotiations stretched 4 years, and this included the COVID period too. He does say that these sort of matters move very slowly, but the good thing here was that the family was very dignified and took advice seriously. The process was complex, and in the end, there were solutions for everything. Prabal Basu Roy, board member and advisor to the board chairpersons, now joins us. Good morning, Mr. Roy. Thank you very much for joining in. Mr. Roy, a 127-year-old family finally gets realigned. The split from the way we know it is going to be where Adi and Nader Godrej will control the listed companies, while cousin Jamshed gets control of unlisted entities and the land bank. What did you make of this? This was amicable, there was a process, it was complex, but solution was found. I guess this does become the blueprint of future realignments of families that we may see come our way.
Good morning, Samina. Good morning. See, there are multiple aspects to this, like this was obviously done for succession planning at the group level, responsibility to stakeholders, and social responsibility. I think they took all these three into consideration while designing this package to make sure that such large groups, when they split, things can go horribly wrong, like with massive value destruction. like, say, in the case of Reliance and Ambani side, or Thappers for that matter. So I think due care was taken. And the thing which I liked, as you rightly said, and I expected no less from the house of Godrej, was that it was done very quietly and professionally over the last 4 years. And most importantly, in a respectful manner in which it was achieved, and therefore the spirit in which it was done. And that is very important. But having said that, Samina, if you have a minute, I would like to touch upon another aspect, which is the larger aspect, actually. If you have time, I can talk about that.
Yes, please.
See, and that aspect is, and I'm writing about this, like it or not, in our part of the world, family control will remain. And promoter-driven entities, the matter of succession will come up with every generational transition or two in terms of distribution of assets. Now, this is very different from what is there in the West, where most family groups, retain shareholding, a significant shareholding, but the management control has migrated to institutional shareholders-backed managements, professional managements. And the reason for that is massive size and massive complexity. I'll give you an example. I'll give you a few examples. Just take Fortune 500 companies. The Dalton family controls Walmart in terms of shareholding, but not in terms of management. The same is the story with Ford Motors, Koch Industries, Cargill, Hearst Corporation. In Germany, it is the Quandt family which controls BMW through shareholding, but not management. Henkel, Mark, Bosch, many of them. In Sweden, Ericsson, Electrolux, ABB, Volvo, they're all controlled by the Wallenbergs, but they don't have any say in the management. Now here, by splitting these assets in most cases, we are by definition restricting the size from getting bigger, from getting really massive and world scale. And so it's a governance thing. And over the next maybe 100 years or so, who knows? This could happen in India too, when family members realize that, they may not be willing or competent to manage these enterprises on such a large scale. The Ambanis, for example, at the moment will be a very good, interesting case study in the next 3 decades, despite, the current patriarch having taken extreme care and caution in handling the succession. Same goes for Wipro, same goes for HCL. So we are in very interesting times because India is now growing, the enterprise sizes are growing, and yet, it's not fully there in terms of creating mega corporations which can dominate the world. So that's the larger picture.
Right, Mr. Roy, it's all about succession planning, family constitution, being custodians of the significant wealth that some of these promoters have amassed. But one quick question, and I want to talk to you about minority shareholders, because you said that these companies were run by institutions. They are enterprises in their own sense. These are not family-run businesses, even though that's what the foundation is. Will this split have any impact on minority shareholders, in your opinion?
No, I would see that depends in the Indian context. That depends totally on the quality of the promoter. I've written about this multiple times. In governance, you can bring any number of rules you want and laws you want, but unless the promoter believes in minority shareholder rights being aligned to the majority shareholders, it will not work. And there are enough loopholes to make sure it doesn't. Most of it being board governance, etc. Now, as far as the House of Godrej is concerned, I have full confidence, given the past track record, that minority shareholders will not be shortchanged in this entire split, and they will continue to benefit. And the size in which Godrej is, by actually splitting the private company out and keeping the public company separate, and there is huge value unlocking, which is definitely possible, which has probably driven this thing. Because, the private company over time can obviously list itself and go its own direction and so on and so forth. So, yes, as far as the House of Godrej is concerned, I'm personally very confident about the minority shareholders fund.
And very last quick question, Mr. Roy. They've said that, of course, the realignment will be implemented after the necessary regulatory approvals. What sort of timeline do you anticipate this to take? Historically, how long does stuff like this usually take for clearances?
See, there are there are three aspects to a merger or demerger of this size, or a split of this size. One is the legal side, which is, essentially with the authorities, you get into issues like the differences in valuation, and therefore stamp duty and therefore registration and so on and so forth. The other is the financial side, which I think has been agreed between those two sides, and there should not be any problem. And third is purely regulatory, which is the question of approval. So between the legal and regulatory side, I think, especially because that huge land parcel is involved in Vikhroli, I would think anything between 2 years or thereabouts it will take, provided there is no bickering inside the family, which won't happen. In this case, it won't happen. So about 2 years, let's say about 2 years.
Right. Thank you, Mr. Roy. Great getting perspective from you to understand what this means for the Godrej family, what this means for India Inc. and other founder-led companies. It's all about governance, succession planning, family constitution, and this could really be a blueprint for future realignments of companies and corporates. We'll move on from there. There's so many more stocks, and markets, of course, continue to be the biggest talking point as we gear up for pre-open trade. Soni Patnaik and Nirav Asher both join in with their sense on the markets. Soni, I'll start with you. What happened on Tuesday? It was looking really good after a very sharp up move on Monday. Tuesday, up in the first half, new records were made on Bank Nifty and Nifty. And suddenly, boom, right? We've not only just given up the day gains, but we also actually went home with a cut. As we gear up this morning, how would you trade the index?
Hi, good morning, Samina. Thank you so much for having me on the show. See, of course, on Tuesday, we saw, some profit booking taking place in the second half. It was mostly on expected lines just ahead of the FOMC meeting that was due last evening. And, it's just a good sign that, both the indices, they've entered their support level. And it is very crucial because from this support, one can reinitiate the long. So somebody who would have missed out the chance on a Bank Nifty's move, which it tested nearly 50,000 and has completely missed out. It's a good chance that the correction has happened on Tuesday. It has approached the support levels because Bank Nifty is at the edge of its support of 49,000, 48,600, very strong support. So this can be a good level to reinitiate the buy again. And, Bank Nifty can test 50,000. Clearly, it has more strength along rollovers for Bank Nifty from April to May series, and it could just be the beginning. There is a minor hurdle of Bank Nifty around 50,000. Any move above that, you can also see 50,500, 50,800 levels. I think similarly for Nifty, it did make a new all-time high, but of course it was just on a caution note that, it saw some profit booking. There's a range for Nifty right now from 22,600 to 22,800 as well, you can see. So this range may remain for some time. So I think it's a good play. A range play can come out, buy at the lower end of the support range, and then you can sell it at the higher end of the support range. So the range. So maybe from 22,600, one can initiate longs, keeping a stop loss of 22,500 on closing basis, and it also again bounces towards 22,750, 22,800. You can book. Fresh upside for Nifty can only be seen above 22,800. So above that, Nifty can make its mark towards 23,000. So out of both the indices, Bank Nifty is still holding more strength than Nifty. And both the indices, Bank Nifty can clearly show you a buy on dips sort of a formation even now.
Let's get in Nirav Asher into the conversation. Nirav, good morning. Thanks for joining in. I'm going to start off with your view on the Godrej Group companies. I reckon that nothing fundamentally has changed for these companies. There may even be a sentimental uptick because of the fact that, this has all been resolved very amicably. Still, if you consider something like a Godrej Properties or a Godrej Consumer Products, these are perhaps at the forefront of the entire group. Your view on these companies going ahead?
Yeah, good morning and thank you for having me on the show. Yes, I think a legacy of 127 years, and we are seeing a settlement, a family settlement, which has been done in a very, very harmonious way. And the way it has been said is that it's an amicable settlement which has been received. It's likely to be received well by the markets because we are seeing the listed companies being handed over to Adi Godrej and Nadir Godrej, and these of course include the likes of Godrej Industries, Godrej Consumer Products, Godrej Properties, Aztec Life Sciences, etc. And Godrej Boys and the 3,400 acre land parcel at Brokerage being handed over to Jamshed Godrej. Now, I think the shareholders will be more concerned about entities like Godrej Consumer Products and Godrej Properties in particular. But the way it has been coined is that there has been the memorandum of understanding which has been signed between Godrej Construction, Godrej and Boys, which owns that land parcel, and Godrej Properties will continue in the same spirit going forward. So I think it should be a big relief as far as the shareholders are concerned. And hopefully, I think with the baton passing on to the new generation, I think there will be a lot more vibrancy in these companies going forward. So I think we expect something positive to come out of the way this settlement has been worked out.
Sony, your picks this morning, there's lots of earnings, which of course will see stocks react, but anything on the charts that looks good to you or not so good to you?
Samina, the first pick would be in Power Grid. We've seen a clear, strong, fresh breakout coming in Power Grid. It has also given a very strong close above the 300 level, which used to be a resistance earlier. I think it's a strong sign. There is also fresh short covering seen on Tuesday as of the closing happened in Power Grid. From current levels, one can enter longs, keeping a stop loss of 290 and a target of 320, 325 can be seen in Power Grid on a positional basis. The second pick would be from the banking space, like I just mentioned, because Bank Nifty is holding a lot of strength and a good buy on dip sort of a formation. The pick comes in SBI. So SBI, we've seen 2 days ago, it had given a very strong breakout above 800, still continuing to hold above 800 levels. So one can buy on this small dip that we can see in SBI towards 820, 815, keeping a stop loss of 800, and the stock can be a stock of a May series. You can see it testing higher levels of 860, 880.
Sony, Nirav, stay with us. We're gearing up for an exciting and volatile day of trade. We'll take a break. We'll come back and continue our conversation.
Welcome back. This is India Market Open. We're taking stock of the auto sales, all the volume numbers that have come over the course of the last couple of days. Let's get in my colleague Puneet to tell us all about that one. Puneet.
Yeah, thanks for that, Agam. So we're looking at a lot of winners as well as losers in the April auto sales which are reported until now. Do note that they're still trickling in, so expecting the numbers for a couple of automakers still. But one of the key notables was on Maruti basically. So it's come in lower at roughly 5% sales growth versus expectation of 10%. Do note that the company has announced the launch of the new Swift, which is expected to, and the bookings of the same have already started from the 1st of May. Analysts do estimate that there has been, because of the new launch, they've taken back a little bit of the other compact, the older Swift, which would roughly be around 15,000. Tata Motors, on the other hand, the PV sales have come in slightly subdued, just 2% growth compared to the previous year. While we look at the two-wheeler companies, TVS has reported a really strong seller set of numbers. Domestic motorcycle market really strong, coming in at 27% year-on-year growth compared to the previous year. While on their EVs, it's key that the FAME subsidies have been reduced now under the new scheme, but they've sold roughly 17,000 vehicles compared to just 4,000 to 5,000 in the previous year. So they're continuing the momentum from financial year 2024. While for Eicher Motors, they've crossed the 80,000 sales mark. This has eluded them for a lot of times in the past few months. So a strong show from Eicher as well compared to the analyst estimates. While in commercial vehicles, Tata Motors has shown really strong growth, coming in at roughly 29,000. Both analyst expectations as well was flat, coming in at just 22,000. So really strong show coming in from them. We do see that the Navratri as well as the Gudi Padwa festival in April would have been key to the strong growth. While on the other hand, VECV, which is the Eicher Motor commercial vehicle arm, has shown a really degrowth, coming in at roughly 5,300 vehicles versus expectation of 6,500. Finally, Escorts also just flat. So we're expecting numbers from M&M as well as Bajaj Auto soon. Back to you guys.
It's been a good quarter for some of those like TVS. The monthly numbers were impressive. Maruti as well. It's been third straight month of not such great numbers, but nevertheless, the brokerages don't seem to have disappointed at this stage. Nirav, what stood out for you on those auto sale numbers for the month of March? April, actually.
Yeah, for the month of April, I think we've had some reasonably good numbers. Nothing really to be disappointed about. I think, as we've said, that it's been a virtually flawless performance by the auto sector. But there, of course, there is some slowdown at this point of time. But we've seen two-wheelers which have performed quite well. I think Hero MotoCorp has reported a 35% jump in the sales on the back of very good export sales. We've seen very good performances coming in from TVS Motor Company. And as far as Maruti is concerned, there has been some softness, but I think the utility vehicles have done quite well, and the export performance has also been quite good. So that is a positive factor. And tractors have seen some slowdown. We are seeing some slowdown in construction equipment segment also from Escorts Kubota. That is because of the election factor also. I think there's been some slowdown in construction activity on account of that. But commercial vehicles continue to do quite well because the infrastructure sector still continues to perform well in the economy. So I think no reasons to despair. I think the performance still continues to be quite strong. And we also expect some good numbers from M&M and Bajaj Auto, especially Bajaj Auto on the export side. It will be important to monitor the performance.
Sony, very quickly, I want to take your view on, let's actually start with auto stocks because they were the big focus on Tuesday as well before we go into some of those earnings reaction. Anything in the auto pack that looks good? The likes of M&M, Hero, Maruti, anything that would be a good trade this morning?
Stocks from the auto space which have given a very fresh breakout and some good positions. One would be Ashok Leyland. It has given a fresh breakout, was struggling quite a lot to cross that 190, 192 mark, and finally it has done so. Today's pre-open is seeing that it can test 200 levels, but I feel that this could just be the beginning because it has given the breakout after a very long time. So Ashok Leyland for a positional play looks quite strong to test 220, 225 even from current levels. And there's a very strong support of 185. One can maintain a stop loss at 185 and look for higher targets of 220, 225. The second pick would be Bajaj Auto, which has seen on Tuesday it has taken a good support around 8,800, and today could be quite interesting to see because if it holds the 8,800 support and tries to take out 9,000 level again, you can see it retesting the 9,200 even plus levels. I think these two stocks can be quite kept in the radar for from the auto space.
All right. Well, since we have spoken about auto, let's move on and talk about the cement space. Maybe we can get in Nirav to talk about what's actually standing out. Of course, we had earnings from ACC Ambuja. The day before that, we had earnings from Ultratech Cement as well. Nirav, how is the sector looking? Any standout numbers for you? Any opportunities in this particular sector at the moment?
As far as the cement sector is concerned, we started to see the pickup in demand from the last month of Q3, and slowly the demand has been picking up, and that has in a way put pressure on prices. The realizations have been under pressure, but at the same time there have been stable raw material prices, and there has been a fall in the per power and fuel cost. So to that extent, I think it has offset the damage. And as far as the results are concerned, I think we saw numbers from Kesoram and Danya Bharat which were disappointing. But I think we've seen very good numbers coming in from Ultratech, which now has a capacity of close to 150 million tons per annum, and a very, very strong EBITDA being reported close to 1,200 rupees per metric ton. So that is one positive which I see Ultratech Cement. And the second is, of course, Ambuja Cement, which has a capacity of 79 million tons per annum, and it's targeting 140 million tons per annum by 2028. Now, the best part about this is that Ambuja Cement says that cost optimization is the core of our strategy, and they have reported a massive improvement in the EBITDA per ton. Now, their EBITDA per ton is close to 1,085 per metric ton. So I'm very excited about the prospects of these two companies going forward as far as the cement space is concerned.
If you can also come in on Kotak Mahindra Bank, of course, we've had the RBI initiative against the bank at the moment. The bank after that and has since made certain changes in its leadership as well. But given the kind of sharp knockoff that we've seen in this particular bank, at this point in time, the market is split between whether or not this is actually an opportunity to buy into it, or perhaps it's a wait and watch mode. Which camp are you in?
I think it's better to wait and watch because, a lot of negative developments over there. And I think it's better to let the dust settle, wait for some clarity to emerge on the path forward, and then decide to take the lead.
Right. Well, a couple of other stocks, Sony, that caught our attention was, of course, I'll get a view on fundamentally as well from Nirav, was REC. They reported numbers, but like the last quarter, did a 10% up move on back of numbers. As we gear up this morning, Sony, how does REC look? And in that same breath, you've already talked about Power Grid. PFC could be another one, PFC and REC.
Samina, for REC, of course, these important support now to look for would be 490. So if it's not breaking 90 today, defending the levels, you can see it retesting the higher levels of 525, 530 also as we speak. Of course, on Tuesday, we've seen a good breakout on charts backed with volumes. So I think it's very important if it holds the 490 support. So talking about PFC, similar formation again on charts for PFC as well. For support levels, one should look forward to 430, 426 as a support range. If it's holding, then the stock definitely can retest its higher levels of 470 plus levels. So I think these two support would be quite crucial for both these stocks to hold today.
Well, it's going to be important to watch out for both of them in today's trade, but they've been a very, very sharp rally coming in on those counters. While we were talking about Kotak and what that means with the joint MD now stepping down is something that we should find out. Nuvama, I believe, has a rating on that and a call on that. Mahima is standing by with more on it. Mahima, what do you have in terms of brokerages this morning?
Right, Samina. So I'll start with Kotak Mahindra Bank. Nuvama has downgraded Kotak Mahindra Bank to reduce, and it has cut its target price from 2095 to now 1530. They're saying that the negative events and high attrition make the outlook for Kotak very unpredictable. They've also said that recent changes shall hurt the growth in profit at least for next 12 to 18 months. They're also saying that losing a long-standing key manager person is a negative amid the many KMP exits that have taken place in the last year. Digital prowess flagged off as a key strength is lacking and viewed by the regulator. They're also saying that RBI's digital ban shall put the bank 1-2 years behind the aggressive peers and recommend switching to ICICI, Axis, IIB, HDFC Bank for a 1+ year horizon. The next important brokerage that came out was CLSA on InduSInd Towers, which could possibly move the stock. They've maintained buy with a target price of 450, which is an upside of almost 26%. They're saying that revenue are in line with estimates, EBITDA and PAT are above their estimates. They're saying that they added more than expected towers as per CLSA's expectations, and Vodafone fundraiser will provide growth to Indus Towers. And lastly, they have said that potential stake sales could reiterate multiples for Indus Towers. So these are the two important brokerages for the day.
Well, okay. Mahima, thank you so much for getting us that update on, as far as brokerages this morning are concerned. Indus Tower, of course, has come out with good earnings, operationally a very strong set coming in as well. And it's something to keep on your radar as well. Nirav, Indus Tower, is this on your radar? Along with that, the rest of the telecom sector, what's the way forward here? Anything that you like, dislike?
Yeah, actually, as we've maintained this view that the strong response to the Vodafone FPO has augured well for the entire sector. And of course, we've seen strong performances coming in from the rest of the industry players also. We've seen Jio platforms perform quite well. We've seen Bharti Airtel hit a record high. And I think this positive development at Vodafone augurs extremely well as far as Indus Towers is concerned, because of course it is the backbone infrastructure as far as the telecom industry is concerned, and very, very essential service for the sustainability of the telecom services. So continue to maintain a strong view on Indus Towers.
Call coming in on Indus Towers. The stock, of course, was in pre-open is about 1% higher. Let's quickly address a few other names in pre-open trade. If you can get Kotak, let's see how that is doing after the announcement of the joint MD stepping down. Another 2% cut on Kotak Bank is what we have. ACC, Ambuja are some of the ones that will be reporting, reacting to their earnings. REC, after a sharp up move on Tuesday, may see some more traction this morning. Flat to slightly high is what we have in REC. Along with that, stocks like Havells, Vedant Fashion will be responsive in terms of what their earnings were like. Auto companies also, so Maruti, Tata Motors, TVS are counters you want to keep on your radar as well. Sony, apart from that, a few other counters that I want to talk to you about is railway names. RVNL, of course, has had a big order win. But anything else in the railway pack that you'd consider for the May series just before the election outcome?
I think the entire sector seems to be sort of, a bit of a sideways entire range. And, if you just look at, have to pick, then maybe IRCTC can be definitely looked at. There was some good rollovers on the long side above 90% for May series. And the stock is also holding strongly above the 1,000 level. So as long as it's not breaking the 1,000 level, the stock can definitely retest 1,060, 1,070 range. Any fresh upside can be seen above that range where it can head towards 1,100 plus levels. I think the stock is pretty much at a good risk-reward ratio. And if it holds 1,000 level, takes out the resistance, then definitely there's some significant upside can be seen in the main series.
Sony, I do want to very quickly and specifically talk about Nifty's intraday view, because today is the weekly options expiry, and we've all observed what happened last Tuesday. If you just consider today's day of trade, because it's the weekly options expiry, what would your trade be? What levels would you watch out for? Would you deploy options at any point in time?
Agam, if you look at just for intraday today's expiry move, then 20-500 seems to be a good support for intraday. As you can see, the put call ratio of 20-500 strike price is still holding quite strongly above 1.4, which is indicating that the put writers are ready to defend this level today. The expiry range seems to be between 20-500 to 20-600, 650. And, not a lot of upside can be seen. The range can be quite, it can play out in a more of a sideways trend for the day. Last hour, of course, there can be a volatility move we can see. And if it's able to take out the resistance of 20-600, 620 bare minimum, then we may see some 50-70 points on the upside coming in. So I think fresh moves, there could be two sort of strategies to apply for the day. One could be to buy on dips around 20-500, which is a support, keeping a stop loss of 20-400 in cash levels. And from there, it bounces to 20-550, 560 or 50-60 point gain. One can book profits. The second round of strong move on the upside can be seen only if it's able to cross the 20-600, 620 resistance for the day. Above that, at least another 20-700 levels can also get tested. So these are two sort of strategies one can apply for expiry move today.
Right, that's the word coming in on the Nifty and Bank Nifty. And of course, as we gear up this morning, there'll be lots of stocks that will be reacting to their earnings. You've got auto sales, you've got corporate action for the likes of a Godrej and even a Kotak for that matter. Broader markets, remember, will be in focus once again. Lots and lots of broader market stocks have reported earnings, so the likes of an Havells, to an Indus Towers, to the whole bunch of Adani companies as well that will be reacting and responding to the earnings that we've seen. Global cues were almost flat or largely behind us in terms of a no action coming from the Federal Reserve, largely in line with expectation. OMCs will be in focus on back of weakness on crude. So stocks like BPCL, IOC, HPCL could be seeing some buying in today's day of trade. Bank Nifty will be interesting as well after a record high that was on Tuesday. Did a pretty large U-turn. Whether or not that stays is what we should be watching out for today. It's a flat to slightly lower open. Pretty much what we've seen across global equity markets. Asian markets are trading flat. The Nifty as well not doing too much in terms of trade this morning. Bank Nifty as well trades flat at 49,372. The broader markets are outperforming the benchmark, and that's a trend we usually quite like. The mid-cap index is up 0.3%, and the small-cap index also trades with a gain of 0.3%. The Sensex is oscillating between gains and losses, just like the Nifty. The Nifty now, after a flat to lower start, has turned positive again with a 0.1% gain on the Nifty 50, 22,600 being respected in early hours of trade. The breadth is looking good, and I think that's what the street will be very happy with. Like I said, your OMCs are going to be in focus this morning, largely on back of lower crude prices. BPCL is up 2%. HPCL IOC, which Agam will bring to you, will also see some traction in early hours of trade. Power Grid continues its up move. It was a stock that was looking very strong technically, continues to have it pretty good in trade this morning. Adani Enterprise is also having a good morning. M&M is up about 1.5%. It was your biggest gainer on Tuesday after their recent launch. And auto numbers, the stock is up 2%. Banks are not looking too bad. Steel companies are also having it higher. Autos again this morning are trading with a clear positive bias. On the sell side, the Joint MD KVS Manian stepping down means Kotak is sulking. The stock is down 2.5%. In this 1 week, the stock has declined quite sharply in terms of trade. Metals are seeing a little bit of a soft day. Maruti, like I said, it's had 3 months of weakness in terms of auto numbers. The stock is down about 1%. DV's HUL seeing some profit taking, but largely speaking, it's a decent day, Agam. It's flat. It's consolidating. There's a little bit of a positive bias, but the breadth is not so bad this morning, and I'm guessing the street will be taking heart from that.
Yeah, it certainly will be taking all those factors into consideration. But we're also taking stock of the earnings coming through. And of course, from the broader markets, let's pull up all the companies which will be in focus, see how they are in fact reacting to earnings. Havells, of course, right at the top of the list. A very strong set of numbers coming in. But I reckon we also have a downgrade that possibly could be because of, well, the valuations. Of course, right at the top in terms of earnings impact, we have ACC, Ambuja, both of them flat. ACC actually came up with strong earnings coming through. Of course, Adani Power, on the other hand, is also, well, marginally in the red. So not too much of an impact there. Very strong revenue growth, but there's been a one-off, when it comes to the bottom line on account of certain taxation moves. Moving on to other companies which are also reacting to earnings, well, we do have something like Havells up around 1.3%, as I was suggesting that while the earnings have been good, valuations are working against Havells at the moment. IndiaMart Intermesh, on the other hand, looking at a sharp up move, up around 4%. Gravita India was the other one, where you have a lot of high net worth individual interest here, but I reckon that the earnings were a tad underwhelming coming into. But let's move on and talk about the other stocks which are also in focus. Of course, in the newsmakers, we have RVNL, well, yet another order there. BSE, of course, making an up move around 2% after it has raised your transaction costs on certain products. And that was, of course, on expected lines considering the SEBI move that we saw about a few sessions ago. Besides that, we have banking stocks in focus as well on the KVS money and impact. Well, Kotak Mahindra Bank down around 2.7%. Federal Bank, on the other hand, up by just as much. And among others, we're also keeping an eye on the automotive space. Auto sales coming in, Maruti Suzuki under a tad bit of pressure, down around 1%, perhaps on expected lines. TVS Motor Company up around 1.5%, also on expected lines because of strong numbers, and Escorts also marginally in the green. So all these three companies are largely reacting to the kind of volumes that we've seen. All in all, a mixed day of trade, Samina, but more gainers than losers.
Yeah, and I think you've highlighted a few of those broader market gainers, but REC stands out for me. After 11% move yesterday, the stock is up nearly 4.5% as we see, 4% now. 526.70 is what we have in REC. Pull up PFC as well, because along with REC, it took PFC higher. 2 in trade, 3% on PFC is what we have. I talked about BPCL. Along with that, HPCL and IOC are also looking really good on back of lower crude prices. BPCL is up 1.5%, HPCL is up 3%. IOC also should be seeing some buying, just about kick-starting the day, I guess, for IOC is what we have. Chola Invest is up 5%. Rainbow Children is looking good. Adani Total, after a good set of earnings, the stock gets a massive thumbs up, 4% higher on Adani Total is what we have. Apart from that, Great Eastern Shipping, Federal Bank. It seems like Kotak's loss could be Federal's gain. We will, of course, get some more details and confirmations on that. But for now, Federal Bank looking excited and trained on market news, or, of course, rumor. If rumor had to have it, joint MD KVS Manian could be joining Federal Bank, and on back of which the stock sees a 2% gain. Capital market stocks still looking really good. Indus Towers, if I can get that one up. Good numbers. Brokerage is upgrade the stock. All in all, it looks pretty good on the way Indus Towers is playing out. 2% high is what we have. Havells, I think Agam already referred to those numbers. Good numbers again, 2% higher is what we have on Havells as well. On the sell side, it's no surprises there for guessing that you've got some pressure building continues to stay on Sun Pharma Advanced. If we can pull that one up and see what it's getting up to after seeing it's finally trading flat to slightly higher. So started the day negative, but it's declined, or rather given up nearly 50% of its value in the last 1 month. Patanjali is down 3%. Supreme Industries is seeing a morning of profit taking. AstraZeneca continues to see weakness. In trade, Yes Bank, Hindalco, GM Financial, Cochin Shipyard, Godrej Properties down 2.5% is the way we look at it. So all in all, not a bad day of trade. The breadth is good. A couple of standouts are REC and PFC for me. MOIL also looks really good. Jana SFB also having a strong day of trade, and Adani Total also good stock. Sony, quick one. It's 9:20. If you had to initiate a fresh trade intraday, what would it be?
So it will be in, in this tower, we can see it holding strongly above 360 levels, and the stock is also adding some fresh positions today. So for intraday, 360, 359, good support. So keeping a stop loss of 359, one can look for targets of 366, 368 for the day.
Sony, I want you to come on something like a BSC. Of course, we saw a sharp knockoff about 3 sessions ago, but since then, it seems to have been on a little bit of a recovery path at the moment, though nowhere close to the kind of levels it has been used to trading at. What's the way forward here for anyone who would be interested in perhaps buying this particular counter?
So BSE has seen, some profit booking on charts, and there was quite a recovery from the lower support levels of 2600. So going forward, also that may act as a good support. As long as 2600 is not breaking further, you may not see much downside. On the upside, of course, the resistance is right now where it is heading towards 2900, 2910, and it will be quite important if in today's day it's able to take out the resistance, even close above it and head towards 3000. So I think it's important just to watch out for the resistance and do not hurry into making any fresh longs as for the day. Let the resistance cross, then we can see some further upside.
Nirav, from all the Adani Group companies that reported, what did you like? The market seems quite impressed with the likes of an Adani Total, Adani Wilmar also not too bad. Adani Power's also a decent run. Anything that you like from what you saw this quarter?
Yeah, as far as the base effect is concerned, I think Adani Total reported good set of numbers. Adani Wilmar also a decent set of numbers. But I was particularly impressed with Adani Power and Ambuja Cement. In Adani Power, I think it was a very strong margin beat, and at the same time, we've seen a very substantial improvement in cash flows. At the PBT level, also there was a sharp improvement, but at the PAT level, it doesn't look good because of a deferred tax credit last year. So I think personally very impressed with Adani Power results, and of course Ambuja Cement, which we have highlighted earlier also, that how there has been a cost optimization and what aggressive targets they have till 2028. So I think these two stocks have really impressed overall.
Okay, let's take a look at a handful of other names which are also buzzing in trade right now. And, if you look at the broader markets, if you consider the mid-cap 100, we don't have a lot of momentum on the upside. Of course, one of the top gainers on that particular one is BSC, something that we have addressed with Sony at the moment. But besides that, Federal Bank is the other one, which is also up around 2.7%. We have HPCL, which is up and about. That's also advancing by around 2.6%. And along with that, Vodafone Idea and Indus Tower. So these are the top 5 gainers on the mid-cap 100 index. On the losing end, we have a lot of pressure on Godrej Properties. There is, of course, clarity with respect to the Vikhroli land parcel. And, of course, we know the amount of land that the Godrej Group owns in Vikhroli. But this may not necessarily have to do anything with just the restructuring deal. Supreme Industries is the other, very interesting one, which is down around 3% as well at the moment this morning. And we have Patanjali Food that perhaps is a little bit more of a usual suspect at the moment. And Max Health is also under pressure. That's down around 2%. Well, we don't have too much to speak for when it comes to, the broader markets and the key gainers and losers here. There is one counter which actually piques my interest at the moment, and that's Coforge. We're expecting earnings today. So, let me go back to Nirav and ask him about the mid-cap IT space and if there is anything that stands out for him. Nirav?
Well, I think at this point of time, we would be a little bit skeptical about the mid-cap space, especially after seeing the results of Tata, Elxsi, etc., which have been to a certain extent disappointing. So I think we will be a little bit wary of the mid-cap space and stay away for the time being.
Well, on that note, going to take a moment to thank both our experts, Nirav and Soni, for joining us and taking us through their views on the markets and discussing a whole bunch of stocks and sectors with us. On that note, we slip into a short break, and on the other side, we get you a conversation with the CFO of Chola AMC. Stay tuned in.
Good morning, welcome. You're watching NDTV Profit. Thanks for tuning in. I'm Harsh Saita. We have with us the management of Chola Investment and Finance to talk to us about Q4 numbers, set the context. It's a very strong set of numbers and good growth numbers that they've clocked, and we'll talk a little bit about that. And we have with us Mr. Arul Selvan, as always, the CFO at Chola welcome to NDTV Profit, sir.
Welcome. Thank you. Good morning.
Good morning. So I want to first off try and understand, you've grown extremely well in FY24, 37% year over year AUM growth clocked. So I want to try and understand what the number for FY25 will be. On this slightly higher base, will the number be slightly more tempered, or are you seeing enough opportunities?
No, we will be right now, looking at a growth of around 20 to 25% in the coming year. We are always conservative. There are reasons to it. A large part of our business still depends on the rural economy, and until and unless the monsoons or if you are very clear about how the monsoon settles down, there will be some impact if the monsoons are not so good or widespread. Also, election results we need to factor in, and we need to see how the overall liquidity position with regard to cost of funds, etc., also pans out. There are again differing signals coming from the environment, both from the federal side, and thereby it will have impact on the Indian economy also, as well as RBI by itself. So we need to see how the availability of funds at what cost will make it business sense to grow, because we believe in growing profitably, so we would not be following growth just for the sake of growth. So we need to make the committed ROTA levels to achieve this. So these factors we will certainly watch out before committing on a larger book growth.
Understood, sir. And what segments would you be targeting in terms of your growth? Is there a predominant focus area that you see yourself growing in FY25?
Yes, as a percentage wise, we will grow a little faster on the loan against property, home loan, and the new businesses, because these businesses, the loan against property and the home loan, are making inroads into other parts of the country from where they were earlier, operating from. So the geographical expansion would give them the traction to grow faster, as well as in the new businesses, because the base is low, their growth percentages would look seemingly high, but in absolute terms, Vehicle Finance would still be the largest player with regard to disbursement growth and AUM growth. But overall, portfolio-wise, Vehicle Finance portfolio may come down again marginally. We would have seen that it has been coming down in spite of its growth, but that is because the rest of the businesses are going faster.
Understood. And sir, how quickly would you continue to run down that, or rather just in terms of mix, reduce, or how would the mix shift maybe in the next 3 years in favor of loan against property and home loan as you scale geographies in those segments?
Yes, see, Vehicle Finance will come down to around 50% or a share less than 50%. The loan against property and the home loans by themselves should be in the range of around 30 to 35% of the overall AUM. And the new businesses would be constituting the balance 15%.
Understood. And so new business itself has grown extremely fast, while I'm focusing in more on growth at the moment. But new businesses itself, in terms of disbursements, quarter of your disbursements to new businesses. What's the strategy here? Any concern with regard to you venturing into these new businesses and growing extremely fast without having enough of comfort on asset quality, or you're completely comfortable there?
No, we are comfortable there. We have seen that. We have explained over a few calls over the quarters also on how we are tracking and how we are making, even minor corrective actions. For example, in the fintech partnerships, which is less than 1% of the overall book, but even there we have made corrections to make sure that we don't exceed on NCLs. NCL would be our predominant focus with regard to any business we grow, so that would be tracked very closely on a very online basis, so that would help us to keep them in check. So these businesses would continue to grow, and but Vehicle Finance would be still the largest business, I would say, even 3 years down the road.
Understood. I'd like to talk about Q4 specifically. Margins have come back in Q4, and they've come back decently well for you. You expect this kind of 7.8% kind of margin to continue into FY25 as well? What's the thought and the guidance like?
Yeah, it will continue unless something drastically goes wrong with regard to the interest rate scenario, which we don't see right now. While I don't subscribe that there will be any fast reduction in interest rates, I also don't see that going up drastically. But we need to factor in geopolitical risks, if any, that could push up oil prices, push up the exchange conversions, and thereby lead to interest rate hikes. So we will have to watch that. But for it, I think NIMs can be comfortably held at this level is our thought as we move forward.
Understood. And with regard to credit losses, this time around, you've delivered quite a beat in comparison to what the street was expecting on the credit loss count. Could you talk to us a little bit more on that? What's led to a really decent number on that count?
Credit loss has always been our focus, as I told you a few minutes back. We would be focusing on that, and we have been making corrections. We have been tightening our underwriting principles, and thereby we have made inroads. But also, you should factor in Q4 will always be a quarter where credit losses would be minimum because a lot of push happens to reach targets, etc. It may move back a bit in Q1, but we should be back to better levels as we move forward in the subsequent quarters. This is a trend you will see happening even pre-COVID if you analyze quarter by quarter.
Understood, sir. Sir, with regard to, you've spoken about your focus on profitability along with growth. You're moving into a more secured business of housing finance, of LAP and the like. Does that therefore dilute profitability and margins? Could you try and give us some context on that?
No, the customer profile we focus on gives us a better ROTA. So the housing loan book which we focus on is not on the salaried class where the yields are very, very fine and there's a lot of competition from banks. Our focus is on self-employed non-professionals who do self-construction. So we focus on Tier 3, Tier 4 cities. If you see the yields on this book is above 15%, and thereby if we control the losses and control the OPEX, this portfolio can give us a very decent ROTA, and as I was saying earlier, even higher than the vehicle finance ROTA.
Understood. So just in terms of margins, vehicle finance versus housing, what's the kind of margin profile that would have? Could you give our viewers some context on that?
It's slightly different, between them. Vehicle finance itself has got a wide array of products, right from heavy commercials to two-wheelers or tractors and the used segment, where the yields differ almost more than 10 to 12 percentage points itself between the products. For example, heavies will be, dispersed in the range of around 10.5 to 11% yield, while on the other end, two-wheelers can be in the range of around 20 to 23% yield because, for various reasons, their OPEX is different, their losses could be different, the profile is different, the amount of effort that has to go behind them is different. So vehicle finance as a whole basket, they will deliver a NIM of around 7.5%. The home loan on the other end is a 14 to 15% yield product, and as I was saying, if we could contain the OPEX and the NCL, it should deliver easily greater than 4% pre-tax ROTA.
Sure, understood. So with regard to how OPEX has moved, it's gone up quite substantially when I'm looking at it sequentially. What exactly are you investing in? Could you give us some context on that? And therefore, where should ROAs lie as well as OPEX lie in FY25?
The OPEX increases are on account of different, 2, 3 reasons predominantly. One is, for example, as I was saying, we were making inroads into other parts of the country for loan against property and home loan. And we create separate verticals for every business with regard to sales, credit and collection. So we don't cross-utilize people for any of the businesses. So each business, when we grow, we bring in separate teams so that the focus remains on that particular product by these teams. So this cost has come in. The other aspect is the insurance income is now being also done by us directly, which used to be done by a subsidiary earlier, because we got our own agency license cleared by IRDA. So there are some cost elements associated with that, but that is compensated by the insurance income coming in the top line. So that would increase the OPEX a bit. Apart from that, in the last quarter, normally we will close out all the requirements on, for example, the CSR expense, etc. And as you know, CSR expenses has to be accounted on cash payment basis. So those costs would have also pushed up the OPEX. There are certain one-time expenses, there are certain routine expenses, but broadly the idea is to hold the OPEX to asset ratio in the range of 3%. That's been our target. Yes, we exceeded it this quarter, but we have to look at it as on an annualized basis.
Understood. And so what does this do to ROAs? They've come off by 20 bips probably because of all the rate hikes that have been priced in this year. What should that do to ROAs for FY25? Still hold above the 2.5% mark?
Yes, we track it more on the pre-tax. So yes, we are targeting 3.5 pre-tax, so it should be 2.5 levels easily.
Understood. Got it. Thank you so much, sir. It's been a pleasure speaking with you and getting all of that context. That was, of course, the management of Cholamandalam Investment and Finance on their Q4 numbers. With that, out of time on this one, we'll take a short break, more on the other side. Stay tuned to NDTV Profit.
Welcome. You're watching India Market Open. It's turning out to be quite an interesting morning. Stocks are moving on back of earnings, and We have the whole Adani pack. In fact, most of them are reported numbers, Adani Wilmar being one of them. Anshu Malik, MD and CEO of Adani Wilmar, and Shrikant Kanhare, CFO of Adani Wilmar, join us to talk to us about how it's been for the company in the quarter. Morning, gentlemen. Thanks a ton for joining us. It's been a good quarter on the face of it for Adani Wilmar. You've managed to surpass that 1 million ton on FMCG sales, edible oil expansion. So lots of good things as well that have happened in the quarter. You want to throw some color on how it's been and what's the guidance going into FY25?
Our business in the fourth quarter has been good, particularly in both in food and edible oil. In industry essentials, particularly the oil meal, the volumes were a little less, but otherwise it has been a good quarter. The first half was not as good, but the second half surely has seen much better results, both in top line and bottom line. Going forward, we see a great scope of growing both in terms of volume and improving our bottom line. One, because of the stability expected in the prices of commodities as we go ahead. Second is the distribution reach that we have created over the last 25 years. And now we reach almost 730,000 outlets directly. And indirectly, almost 1.8, 1.9 million retail outlets. Food and FMCG both to put together is increasing at 30% domestic business, growing at quarter on quarter. So that is a good thing to happen, and we have touched 1 million. So going ahead, I see great opportunity for AWL.
Malik, that's amazing. It looks like it's a promising year ahead for the company. But let's break that down, right? I want to talk to you about what rural demand is looking like as we go into FY25. Are you expecting an uptick on that? Give me a sense of guidance of what we can expect on top line and exports as well. Any plans to revive that piece of the business?
On rural, you see, last year hasn't been good from agri production point of view, and the growth of agriculture has been much lower than expected. Normally it is 4%, but was 0.7%. That is because of the erratic monsoon in the first half of the year. The Rabi crop was good. Wheat and mustard was a good crop this year, and that has given some solace to the farmers. We are looking at the Kharif crop and the monsoon, and you know how important monsoon is for the rural economy. What is predicted to be a normal and a better monsoon, if this happens, I think the Kharif crop will be wonderful. With Rabi good and the Kharif crop coming to be good, I think by September, October, we will see revival of the rural demand. That is one side, but for Adani Wilmar, we have been in staples business. And staples are all essential commodities, whether you talk of wheat flour, rice or edible oils, and all these things are required by even the rural consumers. We have in fact seen 1% growth over the urban. So our share of rural has gone up from 30% to 31%. So to that extent, we have seen rural demand better for us, principally because edible oil prices have been lower than last year, and wheat and rice prices have been stable at least at that level.
Shrikant, if you can actually come in on the pricing environment right now. We're seeing an improvement in your margins in the third quarter. And of course, pricing, I believe, has been dynamic because you guys have been making a lot of decisions based on market conditions, which are also very volatile. Firstly, how has pricing impacted margins in this quarter? And what's the way forward? If you could also give us some sort of an idea about your expectations of margins range as we move into FY25.
Yeah, so if you firstly look at this quarter, we have, of course, outperformed as compared to the same quarter last year. But having said that, of course, in our business, there is always an overlapping between one quarter to another quarter on the inventory gains and the contract gains which are sitting, which sometimes gets delivered either in the quarter one or quarter two. So with these, I think the numbers are quite good. Coming back to your question on the pricing and how does pricing play in our overall scheme of the thing. See, we have been saying this for quite some time that our revenues are basically impacted due to inflationary pressure. So in most of the time, given that we have a very strong brand, number one brand in the country, we have been able to pass it on any inflationary pressure to the consumer. And therefore, our entire focus is always on how do we improve the margins per ton. And that is something we've been able to deliver in this quarter. Whatever we faced in Q1 and Q2 was very unprecedented because of the high price inventory and the disalignment of the hedges. I think that that problem is now behind us. We have been going back to our normal numbers which we used to deliver in FY22 and FY23. And therefore, having said that, Q1 margins, if you really ask me, should be in line with what we were delivering earlier. And of course, should be better than what we have delivered in this quarter.
Would it be fair for us to assume that there will be upside risk, if I can call it that, on margins going ahead into FY25?
Really don't see there is any risk on our margins, given the two factors. One is all that commodity volatility that we saw in Q1 and Q2 is behind us. I think markets have stabilized, prices are stable. And whenever the prices are stable and in a range bound, I think companies like us who have got a good brand in place makes better margins. So therefore, I don't see any risk as such on a business model. The second thing, of course, is the food segment or a food portfolio in the company's overall basket is improving. So this quarter, we had been able to clock 17% of volume came from the food. We have been able to clock 1 million tons of food volume, which is quite a remarkable feat for any company to achieve. The food gives you a better margins, and therefore, when you move ahead and in the next year, when the food proportion also increases, edible oil prices remain stable, I think we don't see any risk on the margins as we sit today.
So there could be a good possibility of improvement in margins in FY25. Mr. Malik or Mr. Kanhari, either of you can come in on this one. Talk to us about branded products because your market share that has been improving consistently over the last 10 quarters. As we go ahead, what sort of margin, what sort of guidance can you give us in terms of the branded products?
See, staples business is all about good supply chain management and very good distribution. If that is there, then the market shares can improve. So we have been working on that segment since last 3-4 years, very clearly with a focus after COVID that distribution is the key to success. So we have gone in roads from 16,000 rural towns. Last year, we did around 33,000. Now we will do 50,000 target we have taken. Rural sits on a bigger population of almost 70-75%, but the share is 30-31% for us. So we have enormous scope to grow. Second, the challenge in distribution in rural markets are on supply chain and your logistic cost. Now that our volumes are big enough, we did around 6 million tons total as a company, and edible oils volume, packed volume were 2.7 million tons, and food 1 million ton. Put together gives us enormous strength to move goods at a lower cost and thereby give value for money to the consumers. We are confident of getting higher market share as we go ahead.
All right. If I can also touch upon industrial essentials at the moment. Now, the second volumes have seen a little bit of weakness coming in, at least on a year-on-year basis for this particular quarter. And I reckon that this can be attributed to the weakness in oil meal. Can you take us through what's really happening with the segment? I believe that exports have also taken a hit here. What's your reading about the way forward?
On industry essentials, oleochemical is a big business of ours and has been growing at around 15-20% per annum, and we are expanding that. We have an export portfolio also, but oleo has done very well. Castor, we are world's largest castor oil player, and we export. We are the largest exporter also. Now, in Castor, plants are running at almost 95% capacity, so not much of growth, 5%, but we are expanding there also. What comes is the oil meal export. Oil meal is a matter of, consumption at the destination and how price effective we are. And in soybean, the South America meal is cheaper. So that gives us a disadvantage. Our advantage is only that we are non-GMO meal. So we are exporting to Korea, Japan. What happens is that you need little time to develop these markets because there is a lot of back and forth in terms of quality control and specs and all that. But surely we have cracked that and we will see better oil meal exports. Other than oil meal, rest of the two business, castor oil and oleo has been surely have done better.
Well, thank you very much, Mr. Malik and Mr. Kanhar. It's been a good quarter. Wishing you all the luck and congratulations again on having it good this time around. And good luck for FY25 and we'll see you soon. Well,
thank you.
In the meantime, the markets are volatile but holding steady. Lots of stocks are catching our attention. REC, PFC, the biggest gainers. On the street, you've got gains coming for Adani Total, OMCs as well. Other companies like Vedanta Fashion, India Mart are some of the top gainers on the Nifty 50. You've also got Raymond that's having it well. Chola posted its earnings is up 4%. Federal Bank, on anticipation of KVS moving to Fed Bank, is doing well with a 4% gain. HPCL is looking good. IRP, PHEL are all having a pleasant morning. With that, we're completely out of time, but thanks for watching. Up next, I catch up with Harold Vander of HSBC Emerging Market Strategy to talk to him about what it looks like for India going ahead. So stay tuned.
36 lakh farmer families affiliated with Amul across 18,600 villages of Gujarat have pledged to vote with their families during these elections. I would also urge you to take this pledge and vote as a part of the democratic process of our country.
welcome. You're watching Talking Point, and joining us today is a very special guest, Harold van der Lind, Head of Asia Equity Strategy at HSBC. Harold, thank you very much. It's always great talking to you, and it doesn't get better. The start of a brand new month, a month ahead of elections locally, lots of global and local factors to talk about. But I'll start with the most important one this week, and that is the FOMC meet. Bets are on whether or not there will be a rate cut at all in F5 in this calendar year. You want to tell me what the possibility of a no Fed rate cut in the current calendar year, considering the kind of economic data that we've been seeing coming out of the US?
Yeah, well, good to talk to you again, Samina. The Fed is extremely important for Asian equities. And you're right. We started this year with the market saying, hey, maybe it could be as many as 5. Some banks were even talking about 7 rate cuts this year. That's really being pushed out of the window. And now some people are talking about maybe rate hikes even this year. Now, I think that might be a bit too early to judge it. But clearly, some of the inflation numbers have moved a bit in the opposite direction than in the beginning of the year. And it looks like we might not even get rate cuts this year. But for the moment, our base case is still that there will be rate cuts coming through, but clearly there's risks to that particular view unfolding, and the market is repricing that.
And Harold, interestingly, in the month of April, we've seen FPIs actually sell out of India for the very first time in the year so far. And this is not just equities, it's debt as well. Do you feel like rising bond yields could mean markets globally and India in specific could see outflows from the US investors?
Yeah, well, I think there's 2 things going on. It's something on China and what happens globally. So globally, yeah, interest rates and bond yields in the US have gone up. So it makes a little bit more sense to put money into the US market again. I'm really talking about US money markets, right? Putting in deposits, because there you get 4.5% or maybe 5% on certain deposits again. So I think we've seen money move a little bit out of equities in general, all around the world, and India is no exception. So I'm not overly worried about that. That's, I think, sort of a near-term sort of consideration for India.
And let's talk about China, because I know you've been tracking that very closely. And the last time we spoke, you were constructive on China, but I believe you are even more constructive on China today. The yen is at a record low. US bond yields are rising. India may or may not be seeing FPIs come in lock, stock and barrel, and that could have to do with the local factors such as the elections. Where does China stand, and how much of China's potential inflow could eat into India's pie?
Well, before China, very quickly India, because we do really like India, but it's just a market that's performed so well. It's rather expensive, so we say maybe we should wait until the slightly better time. But it's a market that we effectively still like. China's almost the opposite. China's got an enormous amount of challenges to deal with that are well presented in well, you guys have talked about it as well, property, economic growth, and all these sort of things. But we've seen such a massive sell-off that now China, a lot of people say, hey, maybe it is a bit overdone. And it comes at a time where India is expensive, and you see that the